Well, hey, welcome everyone. This is Chris here. Excited to have you guys out today, and especially excited for this special webinar you guys get. You get an extra special treat this week for sure. But rather than hearing from me, we're going to hear from Glenn Stromberg. Glenn, just kind of let you know about him. Like, he's the one I already mentioned yesterday in our call where, man, if you want amazing, whether it be prefab homes, you turnkey properties, whatever it might be, right? If you want awesome deals and get great cash-on-cash returns, this is the guy you want to be listening to. So today we got Glenn on. We're going to have him give a special presentation about how you can not only get these properties and get them at a great price, but also be able to get a max ROI on this. And as I know as you guys want, I know many of you guys don't want to spend a lot of time and attention on it. He also is not only is the one helping you find these properties, but he's also one helping you manage them. So he is like the one-stop shop to help you guys get the max bang for your buck on your deal here. So Glenn, thanks for coming out, man.
Man, my pleasure, Chris. Great. I really appreciate you having me. And like I say, you're an awesome guy, and pleasure to be on the podcast.
Oh, you bet. All right. So I know I need to turn this over to you. Do you have a presentation that you already have prepared?
We do. Whatever, we got it up. And I want to introduce Melissa Hammaker. She's my director of operations integrator in my company, and she's on the call too. And so she actually handles the acquisition department. She's the one they'd be dealing with if they decided to invest with us. So.
Welcome, Melissa.
Thank you.
All right. Well, let's see here. Let me make you the host. All right.
Very good. All right.
Oh, you, man.
Once again, thanks again. And on the screen, can you see our screen, Chris?
I can see.
No, you're the host, Glenn. You'll need to share your screen and then share the presentation.
Gotcha. Okay, very good. Let me grab this here. Let me do this here. Could you make Melissa the host? I'm struggling.
Can you make the operation guru the host, please?
Yeah, that's right.
Yeah.
I think I have to have you unhost it somehow. I think you have to put me back as the host to do that one.
Okay. Yeah, hold on. Let me get on the full screen here. Let me see if I can.
I guess that's true. You could also make her the host. I guess you're the one that has the controls on it.
Oh, sorry about this. Host.
Actually, I just figured out how to do it.
Yeah, because I don't know why I'm not getting the full screen. I'm not getting the choice here.
All right.
It's okay. Chris took it back.
I just took control.
Good.
All right. Melissa, you're on deck.
Yeah.
You got it.
I've been waiting all my life for this. Give me a minute. I'll get you going. Can you see me, my screen?
Yeah, I can see you.
Here we go. There you go.
All right.
Can you see the screen?
Yep.
Perfect.
Glenn, you see it?
Yes. Yeah, I do.
Go ahead.
Okay. Well, first of all, once again, I appreciate everyone that's going to be listening to this. And this is our company's mission statement. The thing that we try to focus on is the golden rule. We always talk about it in our team meetings. If we exceed expectations with our tenants and investors, we never have to worry about us. And we want to bring glory to God in everything that we do. So go ahead and hit the next slide, Melissa.
Oops. There you go.
Okay. Just a little bit about me, my experience. I've been in the manufactured housing industry. I hate to say this, but it's been over 30 years. It's been 37 years now, so well over 30 years. A little bit more about my background. I've owned mobile home parks. I've developed mobile home subdivisions. At one time, I had 13 retail sales centers, which is like car dealerships. I also had a Clayton Homes franchise. That's the company that Warren Buffett bought. And so I've had that. And then my current business model, has been in place since 2006, and we're going to talk about that more here. Okay. Melissa, if you go with the next one. Okay. This is
Everyone meet Glenn.
this is the caricature of the team did this on me. I didn't do this, but our slogan is we're not in the real estate business, we're in the wheel estate business. So this is kind of our mascot. Okay, so if you'll hit the next slide.
Not kind of, it is.
It is. It is our mascot. This is our company logo. Matter of fact, I think we got it patented, don't we?
Yes, we did.
All right. And so people always ask me, well, why am I in real estate? Why did I choose to be in manufactured homes versus stick and brick houses? Well, a lot of reasons. They're typically half the cost. In many cases, they're double the cash flow. There's way lower maintenance costs. You don't have, we hear horror stories here in the Dallas-Fort Worth area about $30,000, $40,000, $50,000 plumbing jobs. For us, we take the skirting off, we get under it, we re-level it for $500 to $1,000. So there's a substantially less moving parts, easier to get to. Quality construction, they're built to HUD specifications, they're built in a factory. And I want to say this for everybody out there, manufactured homes and mobile homes, the terms are synonymous. They just cleaned up the name calling it manufactured homes, but they're built in factories. That's the main thing. We've bought over 200 properties in the last 5 years. We use all private lenders, no banks. I have not used a bank in over 15 years. About half of our deals are IRA deals. So, a lot of people do business with Quest and Equity Trust and people like that. That's no problem. We can do that. And we are currently buying 10 houses per month. It says on here, Texas, North, South Carolina, but we're also investing in Georgia and Virginia too. We're in a 5-state area. Every one of our homes are real property. They're not in mobile home parks. They're not personal property mobile homes. They're attached to land, and they have a deed of trust or a mortgage on them, depending on the state. So next slide. And yeah.
You're delayed. It's coming.
Yeah. Okay. And then, like I say, we're operating in 5 states. We're actually looking at Tennessee. We think we'll be in Tennessee in the next month. So we're basically in 6 states. Okay. Next slide. Picture of the home. And I show this because I've spoken enough events and different things. And when you say the word mobile home, manufactured home, people think of a metal-sided house with tires on the roof, right? That's what I think the first image is. But these are really beautiful houses. Go to the inside pictures too. They're tremendous quality. They're 1,400 usually to 2,200 square feet. 3 and 4 bedroom, 2 bath. They're on anywhere from typically a half an acre to an acre of land. And a lot of times people prefer these compared to 0 lot line houses. A lot of times they would prefer our houses. They're out in a lot of cases, they're in better school districts, and they prefer them because they get more square footage for the dollar. If you go to the next one, the site build home quality slide. Okay. Let me know when you get it because I'm not seeing it for some reason.
It's up. It's been up.
Okay. So almost all the homes that we buy, they're secured to an FHA compliant concrete foundation. Okay. So people can get FHA financing if they're living in the home on the manufactured homes. We get the same FHA financing as you get on site built homes. Like I said, they're typically on a half an acre to an acre of land. They're really built with site built home construction. We just listed a few things here: 2x4s or 2x6s, plywood, OSB floors, upgraded window packages, insulation packages. And I always this was an interesting day. My dad was a mason contractor and a builder in Chicago. He came out and looked at 15 of my properties and he went, wow, these are built better than a lot of the track houses in Chicago. And I said, yeah, I told you they're really nice. So, and the nice thing is the properties that we're buying, if you went to buy a new manufactured home, put it on the land, we're buying them at half price for what that would be. So the numbers really work out good. Okay. All right. So we're ready to get into the investments that we offer. Okay. So investment option number 1, we call that, it's just the buy and hold. Okay. The investor is passive. He's a lien holder in first lien position. He or she is a lien holder in first lien position, just like a bank. We pay the investor 6% interest-only payments monthly. This is a 5-year interest-only note, okay? There will additionally be 2 points paid on the back end. We guarantee the return will be no less than 8%, but the typical returns on this are going to be 10 to 12% and higher, history shows, with appreciation. Because what we do is we do a shared appreciation note, which they're going to get 35% of the upside. Okay, and keep in mind the property is purchased at a discount. We're paying 75% of fair market value or less, so there is equity going in. And what we found in a lot of cases is people like this model because it's just easy, it's quick, they get their payments every month, and especially high net worth people because they don't need the income today, and they're building equity, and it's tax deferred. The appreciation is tax deferred 5 years down the road. So a lot of times people who may have an exit strategy of getting out of their practice or whatever they're doing, that's a big component to them. So that's a big factor for them. So
how long do you usually hold these for?
What's that?
How long do you usually hold these for?
You do the note for a 5-year hold, okay?
Gotcha.
And now, good question, because they are liquid also. We have plenty of investors lined up. So let's say, Chris, you did the deal with us, and you had a family emergency, and you needed your money back, okay? We have enough investors lined up to we can you would lose your back end, but you would get your principal back, and you keep all the interest that you have at that time. Okay, because we've got a big network, with the group that I'm in and other groups that that we're in together, that we've got plenty of investors lined up for these funds.
Perfect.
Okay. Very good. If you'll go to the next slide, Melissa.
It's up.
Very good. So this is an example here. The option one real deal example. Okay. The loan amount is it was $60,000. The payments are $300 a month. Okay. The one thing I want to say for everyone who's going to listen to this, you are totally passive on all of our investments, okay? The turnkey model, which we'll go into next, you're totally passive, okay? I always tell people the only 2 things you have to do is wire the money, and number 2, check your bank account to make sure it hits every month, and it will on the first of the month, because we're like clockwork on that, okay? So additional 2 points is paid on the back end. The term of the loan is 5 years, shared appreciation. So in this particular house here, the fair market value of the home is $82,000. We're in it for $60,000. So the investor's percentage is $7,700. Okay, that's what they've got going in. And the typical charts, I always like to say this too. It always bothers me when people are putting in future appreciation into pro formas, because nobody knows what that's going to be, right? This is actual today, so I feel comfortable with this. I mean, the charts for real estate show it goes up 3% a year. Milk, eggs, bread, butter, real estate, they all go up over time, right? But there could be a correction. So our model is we buy everything for cash flow today. We know there will be appreciation equity down the road, but that's just gravy and a bonus, okay? Case in point, a lot of deals that we did in 2012 and 2013 in the Dallas-Fort Worth area here, a lot of those property doubled, and investors made 25 and 34% on these deals. Now, do I think that's going to happen again? Absolutely not. That was just a perfect period of growth and everything else. But traditionally, like I say, this investment will return minimum 10, 12%. We guarantee the 8%. And there's in a higher market, you'll get more. You'll get more. So, okay. And next slide.
It's up.
Very good. Okay. So now I'm going to switch gears here. This is what we call investment option number 2, the turnkey model. Okay. And so the investor is still passive. We do everything for them. Investor gets the tax benefits, the depreciation. That's one of the last things the IRS gives us, that with real estate, you do get that, okay? Investor will get 100% of cash flow and profits upon the sale of the property, okay? So that they will own the property. Of course, they're going to have to pay for repairs or anything that happens. We can offer a 1 or a 2 year extended warranty at closing if they prefer to get that. I always tell people we don't get it, and here's why. because when we go into the property, we are fixing it up like new. We're putting new carpet, new paint, new appliances, new air conditioner, new everything. Okay. We're doing that to protect us, to protect our investors, and everything, the house looks like new when we're done. That's our strategy, because we want deferred maintenance to be pushed 5 to 7 years down the road. Okay. We do not sell you the house and then give you the phone number for a property management company. Me personally, I would never do a turnkey deal with someone that doesn't manage it themselves. We have a full-blown property management department. We manage all of our properties, okay? And we manage all of the turnkey properties. We charge the standard 10%. So what that means for our investors is, once again, they are totally passive. We will do everything for them. We buy the home, we fix it up, we put the tenant in there. We screen the tenants very carefully. I'll let Melissa talk about that at the end of this presentation, because I think that's the critical. We've learned this, that if you get the right tenant in there, life is easy and simple. It's great. If you get the wrong tenant in there, they can wear you out. They can wear you out. And so we've got a very good screening process, what we do and how we do it. So at the bottom here, I put a disclaimer. Of course, no one can predict the future, but our assumption, and history and numbers show this, that equity and appreciation and rent increases over time will more than pay for the repairs. They will more than pay for the repairs. And that has been our experience on our buy and hold models. And, under the turnkey model, you can keep it for a year, 2 years, 5 years, 10 years, for life, no matter how you want to do it. And, what we found out, like the properties that we bought in Texas in 2012, when we started leasing those out, the average rent was $900 a month. Today we're getting $1,200, $1,300, $1,400 for some of them. So there's some of the properties we've got $800, $900 cash flowing right now. So that's the beauty of holding buy and hold real estate. So, okay, the next one is the next one up.
Yeah, go ahead.
Very good. Okay, so here's a real example. The rent's $900. Okay. The monthly taxes, we're breaking that out as $36. The monthly insurance is $50. Okay. The property management fee is 10% of that. So there's going to be a net cash flow of $724 after everything. Okay. And the investment, the all-in price was $84,000. So what we do on this here, we're taking our equity off the table. We will take $15,000. We'll mark the property up $15,000, and that's so we're taking our equity off the table. We're selling it to you. You own the property. We're going to guarantee always a rate of return of 10% or greater. Okay, this particular deal was 10.35%, and so that's how we buy. Our acquisition department does it, but so you will have a 10% plus rate of return going in, with, of course, hopefully the potential for upside and appreciation on that.
And that's with no bank lending. That's just purely cash on cash return.
Cash on cash return. That's correct. That is totally a cash on cash return. Okay.
The end.
The end. Yeah. And Melissa, why don't you go ahead and talk a little bit about the property management side of it, and then Chris, any questions that come to your mind that you think you think your people would want to hear. We can do that. Okay.
Sounds great.
So obviously a big part of a successful turnkey is the property management behind it. We always hear horror stories of investors getting slammed with their turnkeys and their maintenance reports. Us having skin in the game with the investor on the front end and the way we rehab our homes cures that problem for our investors. We take our job seriously. Like you said, we screen our tenants. We do an eviction, a credit check, and a criminal report on all of our tenants. More importantly, our numbers speak volumes. In the last 2 years, I've only had 3 investors miss 1 cash flow payment total because of a vacancy. My vacancy rate is less than 2%, and I manage close to 300 properties. My average days on market is 18 before leasing it. We have a full-time dedicated leasing department. We market to all of the major outlets. Each property is marketed to 80 plus outlets specifically. So we're extremely dialed in on our property management. It's not something that we came to right away. It's a science that we've developed and created over the course of the years, but it's extremely good. So we're happy to discuss any specific property management questions with any curious investors, as always.
That's awesome. Yeah, so let me ask. I have questions on both options. On the turnkey side, so obviously some of these are the prefab homes, right? Some of these are manufactured homes.
These are all we have. We specialize. That is our niche, because that, at one time, it's a funny story, because in the group we're in, Freedom Founders, right? Mm-hmm. I actually was toying with that. I'm going to get into the site-built housing industry, and boy, I got slammed big time. One of the guys said, "That's the stupidest thing I've ever heard you say, because you're in a great niche with you buy the price of your houses half price with greater cash flow. Why do you want to go to?" And he was right. So we totally do manufactured homes, and that's why we're expanding to different states where our business model works good. So
yeah, and that's a big thing in the South and the Southeast. I've noticed too, is that it's not where maybe out we're in the West, like where I am, you wouldn't see those homes as often. There, it's very common.
In North and South Carolina, the reason we went there, 1 out of 5 families roughly live in a manufactured home. It's 18 and 19% of the housing in those states. And like Georgia, Virginia, they're all, there's a bunch of states that it's like that. And we've got our eyes on other states too, but that's why we're in those states. So
just to give other investors an eye into that aren't familiar with them, is just as you have master plan single family communities in the West, and like I myself live in, there's master planned communities with mobile homes. They are not parks. They are real estate on land, and they have all the amenities that you and I would have in single family dwelling stick built. So it's definitely readily available and preferred in a lot of cases in the states where we deal with them.
That's great. And that was a key thing too, is that you actually own the land with it, the half acre to a full acre or whatever it might be, right? So depreciation is part of it as well. You get the tax benefits there, like you said. Do you do any cost segregation on these properties?
That's above our pay grade. That's up to a CPA. We haven't really, no, we have not done it personally yet. That's something that's new, but no, we haven't done it. But I would say talk to someone smarter than me on that. So yeah, you probably could, I'm sure, but we have not done it yet. No.
Good to know. Great. And then option number 1 with the fund, with that one. So explain to people about the points, because I know a lot of people get the interest rate thing, but sometimes people may not understand the whole definition of points.
Yeah,
explain that just briefly.
If it's a $60,000 loan, they're going to get 2 points, $1,200. That's what they're going to get.
Right.
So that's 2 additional points, and then and that comes at the back end of the note plus whatever 35% of the shared appreciation is at that time.
So they're getting the 6% per year paid out monthly, plus they're getting the 2% on the back end. The extra 2% on the end of the 5-year note. And like you said, 35% of all appreciation and gains, right?
Right. And like I say, the charts and history show that's going to be usually minimum a 10% return, usually a 12% return. That's what it really comes out to. And I always like to say it's kind of like it's safe because it's backed by real estate, right? You've got collateral in the property, and to me it's like having a 6% CD with upside at the end of it. And so it's for people who, there's a lot of people out there that just like the note payments. They want to defer some of the back end gains, and they don't want to mess with, they just don't feel as comfortable with the turnkey property. They'd rather be on the lending side. So that's why
that describes most of my clients. Most of them would rather just have the note, not actually have to deal with any worry of the property management, of course, and that sort of thing. And of course, because you're participating in the upside, the profit side, you even there are some tax benefits there too, huh?
Absolutely. So because you're not paying taxes. And see, that's what, with a lot of high net worth guys, which I know most of your people are, if they're making 12% and they're in a high tax bracket, they're really bringing home 7 or 8, right? Or,
That's right.
paying the rest of the government. So this pushes the taxes. This is growing tax. I don't want to say tax free, but tax deferred. And then, they could, do it whenever they want to. See, because here's the other option too. Let's say in 5 years, what we do is this: after 4.5 years, we'll pick up the phone, call the investor, and say, "What do you want to do? Are you having fun? Do you want to cash out?" And if they want to cash out, we cash them out. We've got other guys that say, "No, let's just keep doing this. This is I like it, and this is good." And so it's always the investor's call. So, but that's that's how we do it.
Fantastic. Well, great. Well, those are my questions. I know we have Elo on here. Elo, do you have any questions from your end? I know you jumped on a little bit late, but we just kind of went over those 2 options briefly just now. Oops, you just hit mute, I think. All right. Not sure if he's talking or not.
Were you able to hear me?
Oh, now I can hear you. Yep.
Oh, so I just muted myself before. Okay. Anyway, I thought it was a good presentation. I think your business model is very interesting.
Thank you.
I certainly would like to learn more, but I don't have any questions right now. I think I get it.
Okay.
Cool.
Very good. Very good. One more thing I was going to say, and this is a real important piece. People always like people say, well, don't mobile homes depreciate? Okay. And the answer is yes and no. Okay. If you buy a personal property mobile home, put it in a mobile home park, and you're renting the space, it absolutely does depreciate. It's like a car. Okay. It'll depreciate over time. But when you put it on acreage, you put it on land, when the land and the home are together, they appreciate. Like I say, our properties in Texas doubled since 2012, 2013. It'll go up and down with the market. They're never going to be as high as site-built homes, right? But they're going to go up and down with the site-built homes. And what I like to say too is what I feel, here's my take. I think there's a correction coming. Okay. I can almost smell it in the air. The charts say we're due for one, right? I feel pretty comfortable saying that we're in a recession-proof business. And here's why. There is always a need for affordable housing, always, okay? And case in point, in 2008, I always tell the story. This is, I should have said this in the beginning, but this is how I came up with our current business model. I was buy, fixing, and flipping mobile homes out of my house, okay? Same thing, mobile homes on land. I was averaging $30,000 per deal, doing about 3 a month, and life was great, right? I was like, wow, this is fun. Then the crash hit, right? And the banks froze. You couldn't give away a house. So I had to lease them out. I had 18 properties with investors that had investor payments on it. And I'd rather take a bullet to the head than not pay my investors. And so I said, I got to learn the property management game. So I got educated. I talked to property management companies, went to real estate investment clubs. And it's funny how things work, because now it was the greatest blessing ever, because on the first of the month, we're good now. It's a great way when you buy and hold real estate, the tax advantages. And what I found out in 2008 in that market, people couldn't buy, but guess what? They still need a place to live. And they all go to the rental side. And the rents didn't go down at all during the crash in 2008. In some cases, they still went up because not only that, but we were getting the people that were renting the 3,000 square foot brick houses. Well, they had to downsize, and they come down to. So it actually made our pool bigger. So that was. So I really do feel that because we are the most affordable housing. I think that we're in pretty much a recession-proof. We're recession-proof business. So.
Well, I love the low cost repairs too. That's a key point. I think it's really essential to see that working out in your favor. Because that's always a big worry of a lot of my clients is, all right, what if something big happens? Then all this cash flow I thought I had is not going to be there after all.
Yeah, and you hear about the horror stories, like say with foundations and plumbing when they got to dig through concrete and all this stuff, and we don't have that. And that's what I like that too. Ours is simple. It's very seldom do we ever have to mess with walls and stuff. It's carpet, paint, skirting, new appliances. It's cosmetics. It's not major repairs.
Well, I think that what you had said earlier, it makes it, is exactly what people need to understand is that, yes, manufactured homes do depreciate, but so does every other house. The houses depreciate, the structures depreciate, but the land does not. That's what you're really investing in when you look for appreciation is the land. So
That's
yeah,
correct.
the structures, they crumble, they get demolished over time, and that kind of thing. But when you got something that's, like you said, half the cost, but then allows you to get the same kind of rent, that's a great model.
We like it. We like it. Melissa, you got anything that you want to add? You good?
I
I
had
did have
another
a couple.
question for you. This one I asked you before, about a week ago, is can people actually go, rather than buying all out in cash, can they actually leverage and finance these too?
It's difficult. Now we're working on it. Okay. I think I told you I'm working with somebody that there's a possibility that's going to happen. Okay.
Mm-hmm.
The problem we have with our houses is because the typical house is probably, on a buy and hold, it's going to be $45,000 to $50,000. Banks don't want to mess with that because it's just too small. They make no money.
Right.
That's the main reason. And then of course the big banks, they don't understand manufactured homes anyway.
Mm-hmm.
Now we have some investors that, that they have great rapport at their bank and they've got people at their bank there's people that have done it in the past. Okay. So you can do it, but it's going to be tougher than it is, because when you get below the $100,000 threshold, it's really tough to find bank financing for anything.
It'd be something you probably have to do later on as the property might appreciate too. Well, it has to be, obviously you have to be able to get out at least 50 grand for the bank to even want to give you a loan.
Yeah, let me tell you what a lot of my more sophisticated investors do. Okay,
Mm-hmm.
What they'll do is they'll come in and buy it cash for $60,000. Okay,
Yep.
And they'll arbitrage it. They'll go into their network. Okay, their mom, dad, their someone that they know who's in the stock market, doesn't want to be in the stock market anymore, or has hundreds of thousands of dollars sitting in the bank making nothing. They'll offer them the 6%. They'll buy the house turnkey, offer them 6%. So they'll bring them in at $60,000. So they have $0 out of their pocket, and they still probably have $300 to $400 a month cash flow, and then they go and do it again. That's what a lot of my investors do, because that's what we're trying to do, create win-win situations, right? So in that scenario, everybody wins, and that's the best way to refinance the properties that that I've seen, and there's guys that have done a bunch of that. So
Awesome. Yeah, I love it.
Chris, I did actually have a question.
Yeah.
There are two things really. The first one was, in a recession, I'm wondering if the market you're targeting, you actually see more demand. And the other thing was, if you have a business line of credit, let's say a $500,000 line of credit, that might introduce the possibility of doing, 10 of these. So maybe a question about scale of operation and what you're comfortable with.
Well, we're doing 10 plus houses a month. Okay. We're having our best month ever because we picked up a 15 house package in Texas here. So we're going to do 30 this month. Okay. So yeah, we got plenty of scaling upside, and we're kicking it on all levels. And yeah, if I understood your question right, in a down market, is the demand better? Is that your question?
Yeah, essentially.
Absolutely, because more people are looking for affordable housing during that time. More people have to downscale in a down market, right? So they're going to go from the $200,000, $300,000, $400,000 brick house to our house.
Mm-hmm.
So yeah, we have no problem. We have no problem getting them leased in a down market or an up market. But in the down market, there's a bigger pool to choose from. Yes.
Mm-hmm.
Great question.
Melissa, you're muted.
Sorry.
Yeah. There you go.
I would add to that in a down market, you definitely see the demand increase, but not only that, you see the tenant pool increase for better tenants because they're moving out of the stick-built homes. And so that's really helpful. Also, to your other point, most of our investors have 6+ houses with us. We're very comfortable doing that. Our large guys, they tell us, I have 500,000 to deploy, and I can normally fill their order within 30 days without a problem.
Wow.
Okay.
Good to know.
That's great info. Thanks.
Awesome.
Yeah, we feel, I was just out in the Carolinas with our acquisition team, and we feel we're going to be at 25 houses a month here in the next 6 months. That's what we're shooting for. That's our goal, and we think we've got the people and we've got it in place right now. So yeah, we think our acquisitions are going to be, like I say, 20. We're pushing to get to 25 a month.
Yeah, I just had another thought too. Another possible strategy. I mean, obviously these are both great cash flow plays, but I could see also from an IRA perspective, somebody has a self-directed IRA. The one thing I just told somebody today, I said, do not buy turnkey rentals, especially if they're financing. Do not buy turnkey rentals with your IRA because you got to put twice as much down. You get a higher interest rate. It's just doesn't make great financial sense. You might as well do a fund or something. But in this case, we are buying all in cash. That's definitely a great option for growth, appreciation, and everything within that IRA, huh?
Yeah, we have a lot of people that do lending deals with us, and they do turnkey deals in their IRA. We've got a bunch of people that do both. So
awesome. Good to know. All right. Well, hey, if somebody wants to get a hold of you guys and contact you, obviously, I know they reach out to Melissa. Is that correct?
Yeah.
Yep.
Yeah.
What's the best way for them to reach out to you, Melissa?
So you can reach me at my email address. It's Melissa, MELISSA @StrombergInvestmentGroup.com, or my cell, 214-226-1728, either one.
Perfect. Awesome.
And I'm always happy to talk. I mean, as far as, for the acquisition side of it, but I'm always happy to talk to people too, and, and to go through it with them. And I enjoy doing it. Mine is Glenn at Stromberg, and Glenn with 2 N's, GLENN, at StrombergInvestmentGroup.com. And my cell is 817-966-1258.
Awesome. Well, Melissa and Glenn, I appreciate you guys being on today. Really appreciate introducing this. It's fantastic. Great opportunity for a lot of my clients. I know this would be a great fit in many cases. So thank you again for taking your time investing it with us.
Thanks for having us.
Yep. Thanks for having us, Chris. It was our pleasure. Thank you very much.
Everybody else, thanks for joining us. We'll see you later.
All right. Have a great one. Bye.
See ya.